Live from Bloomberg's World Headquarters in New York, I'm Scarlet Fu.
And I'm Joe Weisenthal. We're 30 minutes from the close of trading here in the U.S.
U.S. stocks rising in the first session of the new year, aided by a string of supportive PMI data out of China and Europe.
But the question is, what'd you miss?
House Republicans dropping their bid to weaken the Independent Office of Congressional Ethics after President-elect Donald Trump blasted their move. Plus, as Paul Ryan is re-elected House Speaker and the Senate prepares to challenge Obamacare, what will be left of legislation passed during Obama's administration? We'll get a live update from Capitol Hill. And Ford scraps its plans to build a $1.6 billion plant in Mexico after incurring Trump's wrath. We hear from the CEO, Mark Fields, later this hour. Let's get you started with a check on where the major indexes stand as we head towards the close. Abigail Doolittle is standing by. Abigail?
Hi there, Scarlett. Well, we are looking at gains for the U.S. major averages heading into the close, but it's worth noting that the major averages are well off the highs. The Dow, S&P 500, and NASDAQ had all been up more than 1% earlier today, taking a little bit of a leg lower mid-morning, late morning, as oil, in fact, traded lower. We'll be getting to that in just a little bit. While the Dow transports had also been up more than 1% earlier today, and as you can see, heading into the close a bit red. As for one sector that is outperforming, though, we are looking at the auto sector. The S&P 500 auto index is up nicely, in fact, on pace for its best day since December 9th, and it's a broad-based rally. We have Ford, GM, and Fiat Chrysler all nicely higher. Now, Fiat Chrysler is benefiting from strong Italian car sales, while Ford, of course, is benefiting from the fact that Ford did say that they are canceling a $1.6 billion plant plan in Mexico. Instead, CEO Mark Fields said that they're going to focus on spending $700 million in Michigan and bringing 700 jobs to Michigan as well. So investors are clearly cheering that. GM seems to be trading up as well after President-elect Donald Trump, of course, did tweet earlier pressuring GM to not move Chevy Cruze production to Mexico out of Ohio. But Bloomberg intelligence analyst Kevin Tynan, he says that the real focus here, the reason that these stocks are up, has more to do with the fact that it will be capacity and jobs added around trucks. And in fact, when we go into the Bloomberg, we use a great function. This is Bloomberg Maps. It was rolled out at the end of last year. This is a map of North America plant production. We see that the bulk for both Ford and GM, Ford in blue, GM in yellow, is right in the United States. Just a few plants down there in Mexico. And, of course, that's the Ohio plant that President-elect Trump is pressuring for GM to not move Chevy Cruze down to Mexico. And down there is the plant that was canceled. So it's interesting to see, again, that the bulk of the production is already in the U.S. Now, very quickly, turning to the energy complex, we're looking at big declines here. We have natural gas trading sharply lower, on pace for its worst day since February 2014. And oil, too, down more than 2.5%. Oil earlier had been up 2%. It appears that perhaps the strength in the Bloomberg Dollar Index has really caught up to both. But natural gas is also being pressured by warmer weather forecast, Joe and Scarlett.
Yeah, it's a relief for some of us here. All right, thank you so much, Abigail Doolittle.
What do you miss? President-elect Donald Trump has picked lawyer Robert Lighthizer, who once accused China of unfair trade practices, to head the U.S. Trade Representative Office. This is further indication that Trump's administration will take a tougher line on China. How is this going to impact the UN and FX reserves? Joining us now is Troy Gajewski, Skybridge Capital partner and senior portfolio manager. Troy, thanks for joining us. First, what do you miss guest of 2017? So
great to be here. Happy
appreciate that. You know, there's all this. People are very excited about the Trump administration and the potential for business in the U.S. We heard it with the Ford CEO talking about that today, and other stuff about, you know, the stocks are rallying and everything. But a lot of the noises that are coming out of this administration are very hawkish on the trade aspect.
Correct.
And are not typically the type of policies that investors and CEOs get excited about.
It's certainly not the Republican Party.
Right, it's certainly not the Republican Party. How do you see these two things reconciling them?
Look, I mean, pro-growth tax reform and pro-growth regulatory relief will undoubtedly be good for domestic growth, but the thing that people haven't gotten their heads around is Trump is not a corporatist president. This isn't the old Republican playbook, right? He's after the middle class, trying to help the middle class and the working class, and there's going to be some issues with margins in certain industries around that. But you guys really hit the nail on the head talking about China, because China is the ultimate risk to Trump's policies. Remember, they've been burning through hundreds of billions of dollars of reserves, keeping their currency artificially strong. Okay, so if a trade war really heats up, that's their ultimate fight-back mechanism is that to let the reserve go, which would clearly cause short-term chaos to some extent.
And the yellow line there shows the monthly FX reserves, and the blue line is the Chinese renminbi spot price. And, of course, the estimated capital flows have been outflows for much of 2015 and 2016.
Also really worth highlighting something you just said, which is that they're spending down these reserves to keep their currency artificially strong. The exact opposite of a lot of the charges levied against China.
Yeah, well, rhetoric is rhetoric in a campaign season. But again, the point is if you look at one transparent risk that could come from a trade war, that is clearly the most damaging, at least over the short term. Now, it would be good for China in the long term because their reserves would be worth far more in the RMB. They could do quantitative easing, clean up their banks. But in the meanwhile, that is the biggest risk that we think we could see this year in retaliation for a potential trade war.
And, of course, we have there a chart showing the dollar's strength versus the Chinese yuan. And China, of course, has been intervening to keep its currency stronger than it would be otherwise. Yep. If you come inside the Bloomberg here, we've overlaid the Chinese yuan versus a basket of currencies, which is how the Chinese government prefers to look at its currency, how it wants to manage it going forward. Does the fact that the Chinese government is measuring its currency versus this basket mean that we're not going to get that massive devaluation that we got at the end of 2015, early 2016?
Well, they've been very skillful. Remember, we've bled out about 7% of value last year. Now, that cost them around $600 billion, so it's a very expensive 7% move. But they've been artfully devaluing against the dollar when it strengthens, and when the dollar weakens, devaluing against the trade-weighted basket. And so that is their goal, to have less dependence on the dollar. But in the short term, of course, all the RMB that's going to be converted is trying to go into dollars. So, you know, they're plugging dams, the breach in the dam here and there. Markets are getting more used to the idea that the RMB will be weaker going forward. And our point is not that we're going to have the chaos we had last August or January. It's just one of the transparent risks that we can see.
August 2015, when there was the one-off 2% yuan devaluation, that caused a lot of turmoil. The slow devaluation has been taken in stride. But as you look out there at the various risks, something like last August 2015 is the kind of thing that could derail the
Well, certainly, if they finally say, you know what, we're tired of burning through reserves, we're getting really very little for this, we're going to let it go 10 to 15%, and then we'll defend it because now we have huge reserves. So you could see a 10 to 15% sell-off in markets. We don't expect that. We're just saying that's one of the transparent risks.
I want to move over to Europe because, of course, that's another source of huge risk in 2017 with the elections and whatnot in the Netherlands and France and Germany. Yet, when you look at European stocks, everything's great. In fact, the stock 600 has entered a bull market up 20%.
How about that,
from its low in February.
The perma bulls in Europe are finally proven right no.
For now. But you're saying there's caution ahead, even with the banks leading the gains here.
Yeah, well, look, I think you have to be honest about Europe, right? They're on the verge of potential fragmentation over time. And you know, Italy's obviously not going terribly well. It hasn't grown in years. You know, Germany has a lot of domestic political issues. Greece is still not resolved. So the question for investors is the discount you're getting in equities enough to compensate you for all those unknowns? And when you look at the forward calendar, you have to assume more volatility. I guess our premise would be, at least now, you do have value. I used that cheerleader comment before because 2 years ago you have all these strategists saying how great Europe is. It wasn't even cheap, and you had these risks. At least now it's cheap. You do have cyclical growth turning. And last but not least, there's been very little written about this or even discussed, but look at the upcoming elections in France. Are you talking about a pro-right, a center-right prime minister or president of France? I mean, that's unheard of. You know, this has been a country drifting leftward for decades. They could actually move at more pro-growth than the U.S. So that is a white swan.
The interesting thing about the political risk in Europe, or political risk in general, is that 2016 had a lot of political risk. It just didn't play out like anyone had expected.
It was the opposite.
Brexit and Trump both
it's all good.
And markets rallied, which makes assessing future elections even harder because even if you say, oh, well, maybe there's an outside chance Le Pen could win, or maybe in the Netherlands the rightist party could win. But if you're so used to the sort of, fool me once, fool me twice, none of this is going to matter, it sort of adds a double layer to the complexity of sort of assessing those risks.
Yeah, look, typically hedging tail events is a way to lose money, except when that, Six Sigma event occurs, right? So if you look at people hedging the RMB, people hedged it for years, lost a little money, boom, made a lot of money. Everybody rushed to hedge and got slaughtered the next 6 months, right? So I think most of the issues in Europe have been widely discussed. It's hard to identify anything that you could put on that says has very little downside and a lot of upside if it transpires. So again, when you look at the French situation in particular, if you do game that forward and you do get a center-right premier, not a far-right premier, but center-right, that is a upside scenario that very few people have contemplated, right? Why? Because they're all focused on the downside. Hey, if I short Dutch bonds and this happens or that happens, or hey, Italy, how's the bank rescues going along? So most of investors' concerns or focus on Europe has been how can I hedge, not how can I participate in the upside. And I'm just highlighting, one potential positive catalyst. But to your point, maybe markets sell off then.
Right. Who knows?
Could oil be a positive catalyst in 2017? I mean, we have OPEC agreeing in an unprecedented way, along with non-OPEC producers, that they're going to reduce production.
So when you step back, the reason oil was so debilitating the markets is it traded at 100 forever. Nobody expected it to go to 80. It ended up in the 20s. And that had a cascading effect not only on sovereign balance sheets overseas, but on U.S. credit markets. So most of the recovery in oil to credit markets has already been priced in. There's not a lot more upside there. People have come to terms. Company X is going bankrupt. Company Y will make it. They've raised new equity. Most analysis we've seen that's thoughtful, and again, with a lot of variability around oil prices, is around 60 at the end of the year, maybe even higher. So that will provide a mild tailwind to inflation, a mild tailwind to growth, a mild tailwind to corporate credit. But it's not going to be a substantial upside surprise that's not priced in. The biggest upside surprise will be, can we get tangible economic benefits to growth this year from pro-growth regulatory reform? Because pro-growth tax reform, that'll take 6 months at least to have any tangible impact on the economy. So how fast can pro-growth regulatory reform impact the U.S. economy?
All right, Troy Gajewski, Skybridge Capital Partner and Senior Portfolio Manager. Thank you very much.
Pleasure to be here. Happy New Year.
Happy New Year to you, too. Coming up on What'd You Miss, Ford President and CEO Mark Fields announces his company has scrapped plans for a new plant in Mexico. Is this a result of Donald Trump's push for companies to make or manufacture primarily in the U.S.? This is the question we put to him. From New York, this is Bloomberg. What'd you miss? Ford is canceling plans for a $1.6 billion plant in Mexico. The timing of today's Ford announcement comes as President-elect Donald Trump attacked its rival General Motors for making a Chevy model in Mexico. Now, in a tweet this morning, Trump wrote, GM is sending Mexican-made model of Chevy Cruze to U.S. car dealers tax-free across border. Make in USA or pay big border tax.
But Ford President and CEO Mark Field says his company's decision not to pursue a Mexico plant was a company decision not based on the incoming Trump administration.
We would make the same decision. And the main reason for canceling the plant is our next generation focus was going to be built in that plant. And what we've seen is a market decline in demand of small vehicles here in North America. So we don't need that capacity, and we're going to take the focus that was supposed to be produced there and produce it in an existing facility that we have in Mexico.
So you would have made the same decision regardless of what the new administration was saying about this plant, because they'd been fairly critical. But you did, as I understand, talk with the president-elect and the vice president-elect today. Tell us about that conversation. Why did you give him a call?
Well, first off, we wanted to let them know the announcements that we were making this morning, and they were very pleased that we were making the announcement of investing $700 million in our plant in Flat Rock, Michigan, to build two high-tech, an autonomous vehicle and a fully electric SUV. And they were also very pleased that we're going to be adding 700 jobs over the next couple of years, which builds on the 28,000 jobs that we've created in the last 5 years. So they were pleased with our part to contributing to economic development here in the U.S.
But as you say, it was a Ford decision. It was not something that the president-elect can really go out and say he did this for America.
Well, it was what's best for our business. But as you can imagine, David, we look at all factors as we make these kind of decisions. And clearly, we see a more positive U.S. manufacturing business environment under President-elect Trump. We see the pro-growth policies that he's outlining and the tax and regulatory reforms. So this is a vote of confidence that he can deliver on those things.
Well, and part of the vote of confidence is $700 million that you're investing in Flat Rock, 700 new jobs in Michigan there. If you look at the overall Ford level of employment, will it go up by 700?
Yes, overall, we'll be adding these 700 jobs, which, again, adds to the 28,000 that we've created over the last 5 years. And, David, as you know, even today, we are the largest employer of hourly automotive workers in the United States, and we're the largest producer of vehicles here in the United States. And we're one of the top exporters, and we're very proud of that.
Mark, when you talk about exports and imports, we're all reminded today of the tweet that came out of the president-elect having to do with another car company. Starts with a G, ends with an M, right? That had to do with the border tax adjustment. If the country went forward, it would require congressional action with a border tax adjustment. What would that do to Ford's business across the Mexican border?
Well, we'd have to look at it in total, and obviously the Congress that's about to take office is going to be debating that, so we'll stay very close to that and understand what it means for our business. But to put it into perspective, David, 80% of our sales here in the United States comes from vehicles that are produced here in the U.S. Less than 15% of our sales comes from imports from Mexico, and we're one of the top exporters. So it's not just looking at, will there be, for example, some kind of tax, border adjustment tax on imports, but we also have to look at exports, and that's what we'll look at as we look at the impact on our business.
Well, and to get ahead of ourselves a little bit here, have you run the numbers? Because as you say, you're a major exporter, not just an importer. And as I understand the proposal for a border adjustment tax, you get a credit as you export it, just as you got a tax coming in. Net, would Ford be better off?
Well, we're running the numbers right now. And as I mentioned, we are one of the top exporters, but we're going through those numbers right now to understand what it may mean for our business.
And finally, Mark, as I say, there was a lot in this announcement, and I think everyone will be focused on Mexico and their conversation with the president-elect. There's also a lot in here about electrification of vehicles and what Ford sees as a future for EVs. Tell us about that part of the announcement.
Well, this is a massive announcement for us because we're investing $4.5 billion in electrified vehicles, and we're going to be bringing out 13 electrified vehicles over the next 5 years. We've talked about 7 of them today, including an F-150 hybrid, a Mustang hybrid, a Transit plug-in hybrid, as well as a few others. And what we're really doing as a company is we're taking the products, our most popular products, and what people love about them, and making them even better, because with our trucks, you'll get more capability. capability. With our performance vehicles, you'll be able to get more performance from our sports cars. And, of course, from our vans, you'll get more productivity. So it's a really big announcement and commitment on our part, and to lead in electrification here in the U.S. and globally.
And leading, it strikes me, really finally, Mark, is terribly important, because you don't want to be caught behind as customers start to think about car companies and who is big in electrical vehicles. Can you be in a leadership position?
Absolutely. You know, we are the #1 seller of plug-in hybrids here in the United States today, and the #2 seller overall for electrified vehicles. So we want to build on that. You can see that through our announcements today. And keep in mind, we only talked about 7 of the 13 electrified vehicles that are coming. So there's more to come.
That was Ford President and CEO Mark Fields earlier today with Bloomberg's David Weston. Up next, we'll be taking a look at some charts examining Chinese PMI performance over the last year. This is Bloomberg.
I'm Scarlet. What you missed today was Global PMI Day, and of course we had readings across Asia, Europe, and the U.S. that was fairly encouraging. This is the S&P 500 industrials relative to the S&P 500 in blue. So you have the equity performance in blue, and the white line shows the ISM manufacturing number. And what it came in at 54.7 was the fastest pace in 2 years. So you see that nice upswing in the white line. What that does is reinforce the recovery that we've seen in industrial stocks relative to the S&P 500. As a ratio, the line goes higher, which means that industrials are outperforming the broader market. You really see that recovery beginning in mid-2015. It took, of course, an extra leg higher following the U.S. election. And this is, of course, thanks to Neil Dutta of Renmac, who pointed this out. I just like the fact that there is something fundamental, Joe, driving up the rally in industrial shares.
Yeah, I was just going to say, it's kind of like a reassuring chart because it shows that the market does bear some
It's not all hope.
It's not all just animal spirits and emotion. All right, I'm looking at more good data. This time it's out of China, and of course there are lots of different gauges of Chinese manufacturing. Here are 3 of them. There's the NBS PMI, the official one in white, the Caixin PMI, that's the blue line, and then the MNI Business Conditions Index in purple line. And the theme is they're all ending the year on a pretty solid note, all comfortably above 50, all generally the trend being higher. I mean, there are kind of 2 stories going on in China right now. One is that the data has been solid. Another year gone by where there was no economic hard landing, no collapse, no dramatic slowdown. On the flip side, there are still the concerns over the UN and outflows. Those haven't abated, so sort of 2 countervailing stories. But from a pure manufacturing eco standpoint, that's looking pretty good.
And of course, the unknown is how Donald Trump approaches China.
And the total unknown of how they ultimate the relationship with the U.S.
All right, the market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. We are due to end the first trading day of 2016 with gains. The Dow Industrials up 102 points. The S&P 500 gaining 17 points as well. Now, coming up next, we also have some breaking news that Timothy Massid, chairman of the CFTC, is resigning effective January 20th. We'll keep you posted on those headlines. This is Bloomberg.
500 million smartphones.
Moments away from the closing bell. What'd you miss? U.S. stocks starting the year with a slight gain while the dollar jumped on positive U.S. manufacturing data. Oil fell more than $2 a barrel on concerns about OPEC. Post-election rallies resuming after the holiday break as investors digest both warnings and calls for bullish surprises. I'm Scarlet Fu.
And I'm Joe Weisenthal. Welcome to the viewers tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. Happy New Year, everyone. U.S. stocks celebrated the new year by beginning the year with gains. The Dow adding more than 100 points. Within the S&P 500, 10 out of 11 major groups were higher on this global PMI day.
At one point, we were fairly close to Dow 20,000 today, only like 60 points away, but still a little ways to go.
Still couldn't get there. All right, well, the gains in overseas market kind of set the tone here on the first trading day of the year. The European Stock 600 index entered a bull market, up 20% from its low in February of last year. It's now at its highest since December of 2015. Bank and energy shares led the advance. Here in the U.S., the Dow did get off to a strong start. It jumped 110 points at the open, but you have people like Morgan Stanley's Adam Parker warning that the post-election rally may soon fade. I want to focus here on car makers. A lot of interest there because of Donald Trump's tweets. Ford gaining 3.7%. It's adding 700 workers in Michigan now instead of expanding its Mexican operations. Still, if you think about it, 700 workers out of a total workforce of 200 403,000 employees. That's equivalent to 0.34% of its staff.
Right.
So not exactly a significant, meaningful number there. General Motors.
Nice headline.
Nice headline, certainly, and they took advantage of that, investors rewarding the stock as well. General Motors got called out by Donald Trump for building a version of its small car in Mexico. Nevertheless, that stock up 0.8%.
Let's look at government bonds, starting with around the world. U.S. two-year yields rising 0.03% today. Some strong data out this morning, particularly on manufacturing and inflation pressures building, giving a rise there. But the long end of the yield curve did end up unchanged. Two-year yields in the UK moving pretty significantly. Also strong data. You continue to wait for that post-Brexit collapse. It doesn't seem to be happening. Of course, we haven't actually had Brexit yet. Nonetheless, we have not seen decline. So strong upward move in the UK on short end. And finally, here's Germany. Remember when the 10-year yield was negative in Germany?
So long ago.
Now it's so far away from negative. You can see the lift started happening just around 3:30 after regional German inflation data came in much hotter than expected. So you got to wonder if there's going to be some tension at the ECB as the inflation-disliking Germans experience more inflation. Finally, let's look at commodities. Natural gas getting crushed. Expectations of warmer weather. Rough start to the year for natural gas. Platinum rallying 4%. Platinum's been in this really nice sweet spot. It kind of has some precious metal characteristics, but also industrial.
Yep.
Just doing well. And sugar gaining 5%. And oil, I don't know if we have a chart on oil or not.
But you got to mention it.
But you got to mention it. It rallied significantly earlier in the day, but then faded not long after 10 o'clock after some strong U.S.
Yeah, and in fact, it ended with its worst day since December 14th.
Yeah, real turnaround Tuesday for oil.
Total turnaround. You mentioned Brexit. I'm glad you brought that up because I'm looking at the pound here. It took a tumble at around 10 a.m. Eastern time. That's that big drop there. News broke that Ivan Rogers, the UK's ambassador to the EU, unexpectedly quit. Analysts say that this guy's departure makes a good deal on Brexit less likely because he was one of the few people at the top of the British government who really understood the EU and was meant to be a key figure in those Brexit negotiations. So he's out of the picture now. And the Turkish lira, worst performing emerging market, expanded major currency versus the dollar. It fell as much as 1.7%, a new record low. This chart, of course, tracks the dollar strength versus the lira. This is on the 1-2 punch of faster inflation, 8.5% in December.
Jeez.
And terrorism concerns. You have the perpetrator of the Istanbul nightclub attacks still at large. So that's, certainly weighing on the currency. Nomura actually says that the lira will weaken past 4 in the first half. You can see right now it's at about 3.59.
Not that far to go.
Not that far to go. All right, those are today's market minutes. I want to take a deep dive now into the Bloomberg, and you can find our charts using the function at the bottom of the screen. I want to stay with the Turkish lira here because what happens is that not only is the lira at a record low, but traders are exceedingly bearish on it. This shows the bearish options bets against the Turkish lira. It's the 25 delta risk reversal. It's a measure of the balance between bullish and bearish options, and what you've seen is this huge move, negative move in terms of sentiment on the Turkish lira. As I mentioned, faster inflation, not good. Terrorism attack in Istanbul, also not good. But, it is the new year. Perhaps some low trading volume is exaggerating some of the price moves as well.
And often the years turn out very differently than they seem at the beginning of the year. Brazilian real in 2016. So
no, that's a really good point.
Here's a theme that's happening around the world. Inflation seems to be gathering steam everywhere. Let's look at some data that's come out. On this chart, we have the white line, which is Germany. German CPI year over year, 1.7%. That's the strongest number since 2013.
Getting close to 2%.
Last week, while no one was paying attention, Spain CPI 1.5%, strongest number in a couple years at least. And then today we got the U.S. ISM manufacturing report. That's the purple line. And one of the indices, the measures, is the prices paid index, so asking manufacturers how much they're paying for goods. And that absolutely exploded, 65.5 there. You can see on the left y-axis. So pretty much everywhere you look, we're seeing signs of inflation pressure building, the reflation. Now the question is this something really big, or is this just a blip? Or
right, is that head fake, or is it something else?
It's one of the key questions for 2017. So what'd you miss? Risk takers are going to have to analyze several macro issues this year, and they're not all about Donald Trump, believe it or not. Bloomberg macro strategist Cameron Kreis is here. Cameron, You have a great new piece out for Bloomberg users on the sort of big themes, the big macro ideas that people are going to have to be looking at this year. One of those is related to the chart I just showed, the reflation question.
Yep.
How are you thinking about it? Is this something that's just going to keep going up? Are we just going to get to a new moderate plateau? Are we going to return to disinflation as soon as the oil base effects come through? Break it down for us.
I don't need to tell you that, say, the policy mix in the U.S. is of looser fiscal policy, tighter monetary policy, generally is associated with higher nominal GDP growth and a stronger dollar, right? So in terms of reflation, that's not necessarily reflationary for the U.S. in terms of tightening of monetary conditions, but for the rest of the world, a stronger dollar obviously would imply weaker currencies and more inflation for them. What's the real key for macro investors is this it? In terms of, is this a generational turn in the bond market? And as you say, it's kind of close to 2%, even in Europe. CPI is kind of baked in the cake because of the base effect from oil. Thereafter, we're going to need to see supply and demand come into balance, which I think there's a reasonable chance that happens. But the real key is how investors behave. Macro investors for the last 5 or 6 years, in the era of financial repression, it was all about quick hit. Let me make my 3% on this trade. I'll stop out if I lose 1%, and then I'll move on to the next trade. Classic macro investing is hunting for marlin. It's not hunting for herring. So you're trying to make 10, 15, 20%. And when it starts going your way, you give it a push. You give it a kick. For the last 5 years, as soon as it's gone your way, you've swept the money off the table and moved on to the next trade. And I think, the spidey sense. The last couple of months, it's like, I don't know what Donald Trump's going to do for America, but for the market, he's made macro great again. And I think there's this feeling that we can trade like we used to trade. We can push, and we can finally make some decent money because there's been a lean sort of half-decade for global macro as an investment strategy.
Do you see that has already started to happen at the end of 2016, or have we not yet seen that kind of ability to get the marlin?
No, I think you have seen it. Certainly the sentiment amongst all the macro guys that I speak to it's been a complete 180. It's been like nose to the ground, nose to the grindstone, really trying to not necessarily pick up pennies in front of the steamroller, because that's not macro investing, but it's been picking up pennies sort of left, right, and center. But now, I think people are really willing to give the market a chance to move a long way. All
right, so reflation question. What is another big theme for 2017?
Well, we can't talk about 2017 without talking about the Don, right? WWDD. What will Donald do? We've had a lot of promises, and we've had a lot of movement based on the narrative, based on the hope. But come the inauguration, and even before the inauguration, perhaps, the hope trade starts to ebb, and we need to see some deliverance. Tax cuts, I think we can agree, is probably going to happen because that's something that everybody can agree on. Infrastructure, on the other hand, maybe not. We've had Congress, Republican Congress, for the last, certainly in the House, for the last how many years, telling us that deficits are bad, that spending is bad. We need to tighten things up. Are they going to start sitting around the campfire singing Kumbaya? Probably not. We've already seen today with the Essex business that they're not necessarily, Donald Trump and the GOP in Congress aren't necessarily on the same page totally. So I think it's a reasonable expectation that on the infrastructure side, at least, there's room for a bit of disappointment. Even beyond that, though, we've got issues of geopolitics as we tilt away maybe from embracing free trade and towards protectionism, antagonizing China. It plays up to the domestic voters and his constituency, but what does that mean if prices go up across the board and that basket of goods that's $20 at Walmart is suddenly $30? That becomes perhaps a little bit problematic. And that, I think, feeds through into maybe the third area that we need to think about for the year, which is risk. we've had a long period of what I would term financial repression, what equity investors would probably call the halcyon salad days of low volatility and everything goes up in a straight line. But at some point, the negative externalities of everything we've spoken about will come into play. Things like inflation. If we do see a real return for inflation globally, well, historically, that's not good for stocks. It's generally pretty bad for stocks. You see the top of equity market cycles generally accompanied by a rise in inflation sufficiently strong that central banks have to act. Credit has been distributed on the basis of essentially free money across most of the world. You've already seen delinquency rates across certain segments of the U.S. credit market start to rise, albeit still at low levels. But as market rates rise and lending rates rise, as those need to be refinanced, vulnerable borrowers.
Cameron Kreis, great stuff. Thank you very much for joining Bloomberg's Cameron Kreis. Fascinating look at the markets in 2017. And we have some breaking headlines on Tesla, the company releasing some vehicle delivery numbers after hours. Company says in Q4 it produced 24,882 vehicles in 24. Total 2016 production up 64% from 2015. The stock is dropping 4% post-market, however, after the deliveries update. About 6,400 units were in transit to customers by the end of the quarter, and fourth quarter net orders for the Model S and the Model X were up about 52%. In fact, here might be one reason why there was some disappointment in the stock price. Tesla says production delays affected quarterly deliveries. That's been an issue for the company. Amazing story, always concerns about its execution. All right. We'll continue to keep an eye, but in the meantime, Tesla down 1.4%. From New York, this is Bloomberg. Courtney Collins. Let's get to Bloomberg's First Word News. House Republicans have dropped their bid to weaken the independent Office of Congressional Ethics. The move came after President-elect Donald Trump blasted the decision as counter to his call to drain the swamp of corruption in Washington. The amendment was stripped from a rules package by voice vote in the last minute of the meeting. Earlier on Twitter, Trump wrote, "With all that Congress has to work on, do they really have to make the weakening of the independent ethics watchdog, as unfair as it may be, their number one act and priority?" Trump suggested Republicans focus on tax reform and health care. Meanwhile, Trump will dig deeper this week into allegations that Russia interfered with the presidential election. Here's advisor Kellyanne Conway.
He will have a briefing by our top intelligence officials early this week here in New York, Matt and Katie, at which time he will perhaps learn more about what they say. We're tired of the insinuations and the blind quotes and people really leaking to the press rather than dealing directly with what may or may not have happened with the hacking.
Trump has repeatedly cast aside allegations by U.S. intelligence agencies that Russia tried to influence the presidential election through hacking. Moscow denies the allegations. And Paul Ryan has been formally reelected House Speaker. Ryan won the post with an overwhelming 239 votes, with only one Republican voting for someone else. Ryan called the job a once-in-a-lifetime opportunity. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. What'd you miss? Obamacare, the first item on Congress's chopping block. And earlier today, the process to get the health care law repealed officially began. Joining us now with more on this is Bloomberg's Sahil Kapoor, who's in Capitol Hill. And Sahil, the Senate moved quickly on this. This was through a non-binding budget resolution that instructs committees to begin repealing the legislation, but there isn't a replacement in place either. So what actually happened today?
That's right, Scarlett. So what happened today was the Senate Budget Committee put out a resolution, a budget resolution, non-binding, to instruct the committees with jurisdiction over health care to send them recommendations by January 27th to construct a repeal bill. Now, it's very important. As you mentioned, this is only about repealing the ACA. This is about trying to figure out how much of that they can do through the process of reconciliation, through 51 votes, which means they can bypass a Democratic filibuster in the Senate. Democrats cannot stop them. What happens next is replace. That is going to happen on at sort of an unknown future date. This resolution does not touch that, and that's still a big mountain that Republicans have to climb after they move this one through.
Sahil, are Republicans prepared to kill Obamacare without a replacement in place and let millions of people fall off the rolls of the uninsured?
Joe, this is the subject of a big debate inside the Republican Party. The senior members who understand healthcare policy, who work on healthcare policy, know that repealing this law without some kind of a replacement in place would be disastrous. There, people are talking about a 2-year bridge, a 3-year bridge. I've even heard talk about delaying the repeal, the implementation of repeal until after the 2020 election, because that's how afraid some of them are of the political fallout. We're looking at probably about 20 million people who will lose insurance if they don't have a replacement, and this is the big challenge they have, because Republicans are very divided on how to replace it. They have to come to terms with the fact that any replacement that adheres to their principles will cover fewer people. They can talk about choice, they can talk about lowering costs, but the coverage aspect is a major challenge that they have to work through, and that's what Democrats are going to be throwing at them every time they try to move through this.
What has the Democrats' response been so far, or what is the strategy going forward? Is it going to be to put up roadblocks the way Republicans did for President Obama?
The only thing Democrats can do is to make the politics of repeal untenable, and they're going to keep hammering and highlighting the fact that repeal without a replacement would put something like 20 million people out of coverage. Republicans at this point don't have a plan, and Democrats are demanding that they show a replacement before moving forward on repeal. Republicans intend to move on repeal with a delayed enactment before a replacement. So there's a lot of moving parts here, but Democrats don't have the votes to stop them under reconciliation. What they can do is withhold the votes for a replacement and make that very difficult for Republicans.
Let's switch gears and talk about this thing with the Ethics Committee that the House the House Republicans reportedly originally planned to weaken. Now they're backing off that. What's the real story? Why the turnaround? Was it the outrage? Was it Trump tweeting about the timing of it? Why the about face on this?
Joe, it wasn't so much Trump's tweet. Trump's tweet didn't really criticize the substance of the rule change. It criticized the timing and the priorities. It was a pretty mild and milquetoast thing that the president-elect put out. What really changed this, what really turned Republicans against this, was the bombardment of constituent calls to the offices of dozens and dozens, probably hundreds of Republican lawmakers on this. That is a very powerful tool. The fact that this is an easily digestible thing, this is something that Democrats could very easily make political hay out of, essentially saying, The first act of the new Republican Congress was to gut the independent ethics watchdog. Democrats have no path back to the House majority through ideology, but the issue of ethics is exactly the kind of thing that could imperil what seems to be an invincible House Republican majority right now. House leaders recognize that it was a political disaster, and that's why they turned.
Yeah, a bit of a stumble there on the first day back. Speaking of the first day back, Paul Ryan was reelected as House Speaker easily. What did he lay out as his legislative agenda today?
Well, Paul Ryan's agenda has been known for many years. Since he was on the Budget Committee in 2011 when Republicans took over, he's proposed a series of deep spending cuts, a series of deep tax cuts. He wants to make entitlement changes to Medicare and potentially also, although he hasn't mentioned it this time around, Social Security. So that's well known. One very interesting thing I would say about the fact that Ryan was elected overwhelmingly was that every member of the House Freedom Caucus, the conservative rabble-rousers in the conference, voted for Paul Ryan. This is very unusual. Just 2 months ago, they were plotting a coup against him in anticipation of Trump losing the election and planning to blame Ryan for that. The election of Trump seems to have put a damper on the far-right enthusiasm. Now that they know that the president is of their own party, they don't have that same sense of fierce opposition.
All right, Sahil Kapoor, thank you so much. Sahil reporting from Capitol Hill.
Thank you.
And I want to restate those Tesla headlines we got a few moments ago. The stock is falling after the company's fourth quarter vehicle deliveries were lower than guidance. The company delivered 22,200 vehicles versus guidance of just over 25,000. That brings the year-end total to 76,230, also below Tesla's guidance.
All right, we'll continue to monitor that stock for you after hours. In the meantime, we're going to use the Bloomberg to show the fallout stemming from J.P. Morgan's downgrade of Indonesian stocks. From New York, this is Bloomberg. I'm Scarlet Fu. We want to take a deep dive now into the Bloomberg. You can find all our charts using the function at the bottom of the screen. Let's start with today's news that the Indonesian government is ending all deals with J.P. Morgan because, Joe, after the U.S. election, J.P. Morgan analysts downgraded their recommendation on Indonesian stocks by 2 notches to underweight. They called it a tactical response to the vote. Indonesia's government says it will stop using J.P. Morgan as a primary dealer and as underwriter of its sovereign bonds. So this is the league table that shows banks issuing Indonesian sovereign debt. It's for all of 2016. If you're wondering where J.P. Morgan is, it's right here, tied for 6th place. Total debt issued by Indonesia for the year was just over $12 billion here, but only $9.4 billion was credited to these banks. Of that, J.P. Morgan sold $851 million in 2 issuances. And again, that puts it in tied for 6th place with SocGen and Barclays, and pretty much behind all the other big Western banks, only ahead of, let me erase that, Dubai Islamic Bank and CIMB. So JP Morgan's ranking had not moved either, because last year, the previous year in 2015, it was also in 6th place. So it didn't change one way or another. But it's an interesting response.
It's a fascinating story.
It is.
And it shows the sort of power that governments have theoretically over companies that would issue ratings.
And it makes you question, of course, all the sell-side recommendations from firms that are trying to do business with those governments.
That's a really good point.
Of course, again, JP Morgan said this was a tactical response to the vote. Everyone was kind of bearish on emerging markets anyway after the election of Donald Trump, because the dollar rallied and all the other currencies tumbled in value.
Yeah, very interesting story. Speaking of tumbling, here's an industry not doing so great in the market the last few weeks. Restaurants. This is a chart going back to the beginning of the year of the S&P restaurant sub-industry and subsector. And if you zoom in, just since before November, you can see restaurants have been tumbling the last few weeks. There's a lot, for a while people were very bullish on restaurants, consumer spending, the fact that restaurants aren't so threatened by the internet the same way other retailers are. But people are starting to really come up with negative arguments on them due to rising labor costs, which is a key issue. There's a really big gap between food at home costs, which are very cheap. Buying in the grocery store is very cheap these days, so it's relatively more expensive to eat out. And plus, who wants to go out? You stay home. It's a bit more fun, like, watch Netflix.
There's so much good TV.
And play exactly, so much good TV, play video games. Who really wants to bother going out? So suddenly lots of arguments emerging against the restaurants, and the stocks have been getting hit.
You know what? They need to make the restaurant dining experience more experiential, right?
Yeah.
Better payoff.
I think a new industry for you.
All right, coming up, large institutional investors helping the U.S. housing market recover after the crash in 2008. But many of these companies now are leaving tenants out in the cold. We take a look at private equity's real estate empire. This is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News. President-elect Donald Trump's nominee for Treasury Secretary will not be replying to a letter from a Democratic senator who's asking for clarity on his views about regulations. A spokesman for Steve Mnuchin says Mnuchin has requested a meeting with Senator Sherrod Brown to discuss key issues and that he will cooperate, quote, within the protocol of the Finance Committee. Mnuchin's nomination is subject to Senate approval. Meanwhile, Senate Minority Leader Chuck Schumer is pledging to hold President-elect Donald Trump and congressional Republicans accountable. The New Yorker says Democrats will hold Trump to his promise to make America great again, as long as that means creating jobs, raising incomes, giving real opportunities to the disadvantaged, and protecting civil rights. He also issued a warning about the Supreme Court vacancy.
We will hold the president accountable if he doesn't nominate a mainstream Supreme Court justice. President Obama nominated a mainstream candidate in Merrick Garland. President-elect Trump should do the same.
Schumer also warned against a Twitter presidency, saying the issues confronting America are so complex that, quote, we cannot tweet them away. 10 Syrian rebel groups say they're suspending peace talks over what they claim are violations of a ceasefire agreement. The truce, brokered by Russia and Turkey, was supposed to be followed by negotiations this month between rebel factions and government representatives. Over the weekend, the UN Security Council unanimously adopted a resolution supporting efforts to end the nearly 6-year conflict. And personnel at airports and border crossings in Turkey are said to be on high alert. A private news agency says anyone resembling the gunman who's being sought in the deadly weekend attack on an Istanbul nightclub is being stopped and questioned by police. Turkey's state-run news agency says police are holding 2 foreign nationals who were detained at Istanbul's main airport, suspected of having links to the attack that left 39 people dead. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. Let's get a recap of today's market action. First trading day of 2017, U.S. stocks rising thanks to a string of robust economic data, basically global PMI data from China, Europe, and the U.S. Fastest pace in 2 years for ISM manufacturing.
All solid manufacturing, all solid on the inflation front. Very encouraging about this cycle.
Still, we need to bring you up to date on what's going on with Tesla. Shares are falling in after-hours trading. This is after the company fell short of analyst estimates for fourth quarter deliveries. And we know that Tesla delivered approximately 22,200 vehicles in the fourth quarter. That brings the year-end total to 76,230, which is below the company's guidance. Production delays continue to plague the company, and this has been an issue for Tesla for years now.
Yeah, the products are amazing. People love them. The story's great, but still always questions about the execution and timing. What'd you miss? In a business long dominated by mom-and-pop landlords, large-scale investors are shifting collections conversations from front stoops to call centers and courtrooms as they try to maximize profit. In Atlanta, private equity firms are more likely to file eviction notices on single-family home tenants. So is Wall Street America's new landlord? Joining us now to discuss is Tom Shapiro, president and CIO of GTIS Partners, a real estate private equity firm which has about $3.5 billion in assets under management. Thank you very much for joining us. During the crisis, the money that private equity put into housing was seen as a key stabilizing factor in the market overall. A lot of people were encouraged that this money was coming in. Naturally, though, there are some side effects, and the financial industry isn't used to having to foreclose on people. It's another PR issue for the industry. How do you see private equity's role in dealing face-to-face and directly with renters?
Right. So I think first we have to take a step back about why the business existed. After the housing crisis, there was an issue because you have most people who have families in the United States, with obviously exceptions, for example, like New York City, raise their families in single-family homes. And after the crisis, we had this credit pendulum, which was very loose, and then it became very tight. And then you had all these families unable to actually afford to buy a house. So we've gone now from 11 million rented homes in this country to 16 or so million rented homes in this country. Yeah. Just to put it in perspective, only a couple 100,000 are institutionally owned at this point. So it's really a drop in the bucket of sort of a $2.5 trillion business. So what private equity's been endeavoring to do is actually create affordability so people can raise their families in single-family homes. Now, with that said, and the article you guys recently put out is a byproduct, of course, of any business where you have defaults, whether it's a homeowner defaulting on a loan or defaulting on a rental payment. And, of course, we take a approach that we try to work with everybody to the best that we can because, again, we're trying to bring in people who want to raise their families in a house, we obviously look at their criteria, and then of course people have reversals, they lose their jobs, etc. And we try to, the best that we can, like I think all the institutional landlords try to take an approach that we look at them and say, how can we work with you and how can we keep you? But at some point, of course, if people haven't been paying the rent for several months, you have to make some hard decisions.
Right.
But it's a very small default rate, so it's between 1 and 1.5% default rate you're talking about in general across all the institutional players in the market.
Nevertheless, this study by the Atlanta Fed found that institutional investors, and that includes private equity firms, are twice as likely to file eviction notices as smaller owners. So this professional class of landlords approaches a defaulted payment or a non-payment in a different way than, say, a retail investor.
Yeah, maybe so, maybe not. I mean, the data is fairly limited at this point because, remember, they're trying to assemble the 16 million, 16 million homes that are owned mostly by mom and pop. So the data is a little limited. Again, the default rates are extremely low. And with institutional management also becomes better run properties. We have a way, of course, we can much more efficiently run the properties, can charge a different rent stream, et cetera, with them. So I think that you have to take an institutional approach. Why is it any different than how a multifamily institutional owner would own a building with 300 units or a large commercial bank would have with people? But again, I think you have to take a step back and look at the business holistically, which is we are creating the ability for people to raise their families in houses that otherwise there's no way they could, because now they have an ability to actually rent a house because they can't qualify for a mortgage.
So tell us about what your fund is doing and what you see the opportunities are in the sort of single family in the residential space.
So we've approached several different businesses in the space. We saw early on after the housing crisis that we stopped producing homes. We were producing 600,000 homes after the crisis. That was about half of what we were producing right before the crisis, and frankly, the lowest level since World War II and the Great Depression, where we saw demand at about 1.5, 1.6 million homes. So it wasn't long before we had a 12, 14-month supply. Now that supply is about 4 months. So we actually have a chronic undersupply of housing. We're only producing about 1.1 million housing units even this past year, 1,050,000 in 2015. So we've seen this as a big play where we need to be producing much more homes because we're underproducing based on what our general demand and needs are. So we've been backing home builder construction. We've been doing vertical and long-term housing development. We've been doing some urban projects, and then we also buy single-family rental homes. The play there is really all about the millennial owners. The millennials, at this point, 86.5 million strong, are now getting into their mid-30s. At that point in time, as the older millennials start to have families, they now actually have demand for single-family housing units. So 36% of all renters in this country are now renting single-family homes. So it's a big, huge market. As I mentioned before, there were 11 million rented homes. There's now 16 million rented homes in this country. So from a pure play, sort of macro picture, that's the story. Millennials, why don't they buy? They're more transient. A lot of them can't qualify for mortgages at this point. And so we look at certain markets where we view that there's positive demographic trends. And basically, it's people should be buying homes, but a lot of them aren't for a variety of reasons not buying homes. So that's where we see the general play in the market.
And is this geographically focused? I mean, are we talking about urban kind of centers? Not necessarily Manhattan, per se, but near a big city, because the research has been shown that the millennials don't necessarily like being in the suburbs the way that their parents or their grandparents did.
Yeah, so we're a big believer in sort of have and have-not places. If you sort of look at where the trends are, of course, given the new president, things may change a little bit in the Rust Belt. But at this point, we've been really looking at the smile of the country. So we've been looking basically through Texas and the Carolinas. We've been actively buying single-family homes in Dallas and Houston and Nashville and Atlanta. We bought homes in Vegas. So we've been looking around the country, some homes up in Chicago as well. So we definitely view that we take a macro view on the markets of where we believe that the demographic strength, where the job growth is, and then we play in those markets where we think that the yields make a lot of sense. And the general play is we buy at about a 6.5%, what we think unlevered yield, and then we leverage those investments.
Okay, you mentioned the president, or the incoming the president-elect, so good time to seg to that.
Yeah.
What are the key policies that you're watching for? I mean, this is sort of the big question, is what is he actually going to do?
Yeah.
From your perspective, what are the big policy questions this year, and how will they affect real estate?
So obviously anything that creates jobs. So infrastructure, we're looking at, how far does President Trump now go with infrastructure spending? $1 trillion is the headline number. What does it get spent? More people employed, more people have more. Anything that creates jobs is a good thing for our business. Of course, anything that affects interest rates is also important. Interest rates have started to move up, but we'll take job growth over interest rates because, frankly, if people don't have the conviction and don't feel good about where their employment is headed, they're not going to be buying houses. So that's also an important part as well. Tax policy is obviously really important, but again, a lot of this comes back to where the consumer is headed, and that's where we look at how does the consumer feel, how do they tie into housing affordability, and how are they going to behave. But a lot of it is more demographical trends than anything else because the millennials, as I mentioned, are getting older.
I want to go back to that job idea because infrastructure, the spending on that is supposed to create a lot of jobs.
Yep.
Yet we've seen with housing that there's been a insufficient number of construction workers available to build the homes that are needed. Isn't that going to be an issue for the infrastructure?
It is, and also the immigration policy, of course, because a lot of the workers are immigrant workers who work on these housing projects. Look, I think one of the biggest issues right now in building new single-family homes, which plays into the single-family rental business, is the fact that we have had a lot of expense running on building single-family homes, and we've seen that across all the markets because, as you said, it's all about labor. But we see areas like, for example, pockets like in Houston right now, given the backup in oil prices until recently, we actually saw labor prices start to come down again. But certainly labor factors in that. But at the end of the day, I think the most important thing that we have is consumer confidence, feeling good about their jobs, feeling that they've made more money, and that, to me, ties in the best that we've had. We've done a lot of, we're seeing the entry-level buyer come back, and that's been a really important play.
So, obviously, President-elect has a real estate background, attuned to the issues of the industry. Are there certain, say, regulatory or other things that are of interest to you, not so much on the economic policy, but things specifically related to real estate that you think that are important for the industry that this incoming president may be achieving?
Sure. I mean, a lot of things deal around the debt markets and the Dodd-Frank, and because the debt spigots, as I mentioned, this credit pendulum really has a lot of effect on real estate. Is how do you finance these projects? And so, to the extent that some of that gets loosened up, it would be really helpful. There's new loss retention rules that I'm sure you're quite aware of in the CMBS markets that's starting to slow back and start to decelerate some of the debt markets. So I think anything like that will certainly be helpful. But I would say headline, it all looks very good. I'd say big picture, we feel quite good about what's happening.
Great stuff. Thomas Shapiro, President and CIO of GTIS Partners. Thank you very much.
Thank you. Thank you both.
Coming up, weakening retail traffic caused many retailers to be much more conservative in 2016, but it is a new year, so what does 2017 hold for apparel and the retail industry at large? This is Bloomberg. What you missed, Bloomberg Intelligence has released its 2017 outlook, and we've been taking a look at what you can't miss in various sectors for next year, or this year, I should say. Today, we are looking at apparel and retailers, and joining us now is Bloomberg analyst Hen Grazudis. Hen, before we get to the outlook for 2017, give us a sense of what we saw at the end of 2016, because discounting has been rife, or had been rife, in the lead up to the holiday. And of course, after the holiday, if you look at your email feeds, it's discount here, 50% off there, 60% off there. What did it look like this year compared to the previous years?
So it's really early since we just got back from the vacation and holidays. But what are we seeing, at least from promotions in the store and by emails, if you compare it year over year, there's still discounts out there and you still see the 50, 60%. But year over year, the stiffness of the discount is not as bad as last year. So it's kind of a good sign, but it's very, very early in the game.
Do you have any sense right now of who the big winners were the holiday season, who, when we're looking back, really knocked it out of the park with what they're selling?
So again, it's a little early to say that, but I think, the athletic trend out there is still kind of very strong. So the companies like Adidas, like Nike, Foot Locker might be some of the brands and retailers that are going to do a little better than others.
So in terms of the outlook for 2017, Julie Hyman and I spoke with the CEO of PVH, which of course owns several brands. And Manny Chirico was talking about the confidence that the industry has at large because of the incoming administration. Let's take a listen to what he said.
I've got a great deal of confidence with the new administration coming in, the excitement in the business environment that's being built up from tax policies that look very positive.
So the tax policy is something that comes up again and again among retailers, yet these apparel companies depend on factories in low-cost locations, such as China, such as Pakistan, to keep their goods cheap. Isn't that going to be an overriding issue over tax policies?
So, again, it's very, very early. We don't really know what the new tax rules are going to be. So it's really hard to quantify it at this point. But I'm just throwing a stat out there. Between 95 and 98% of apparel and footwear sold in this country are not made here. They're imported. In terms of units, it's a little less when it comes to dollar value. So any change in the tax rules when it concerns trade is going to have serious implications, both on brands and retailers, and in the end of the day, to consumer as well.
Yeah, a lot of interest in the border adjustment tax and how that's going to affect importers, including some retailers like Walmart. Weigh the risks for it. How big of a deal could it be in the worst case scenario if it gets fully implemented? Like, how should investors be thinking about this challenge for 2017?
So I think, again, if that's really going to happen and it's way too early, I think they'll have to weigh it category by category. Okay. So some categories are not going to be as exposed to imported goods.
So, for example?
Apparel and footwear are the highest by far. To less extent, automakers. Home improvement to some extent because lumber is made here. But apparel and footwear by far it's going to be the category that could be affected more than anyone else.
So talk a little bit about the supply chain improvements, because that's one area where the companies do have some control and are not necessarily waiting for the Trump administration to make policy. What kind of improvements have we seen on that front, and how will that be refined in 2017?
So traditionally, if you look at retailers or brand like Ralph Lauren and Gap, when you look at the process of making a product, it used to take about 9 months from design, doing the sourcing and actually bringing the product to shelves. Looking at retailers that have been successful as of late, H&M, Zara, the process is a lot shorter. So a lot of those companies, like the one I mentioned, Ralph Lauren and Gap, are looking at the process to make it a lot shorter. So Nike, for example, and Adidas created this whole new tool that within a month a designer can choose the fabric, choose the cut, and within a month have the product on shelves. So making that time frame a lot shorter is enabling them to chase the trend instead of just planning based on some kind of a future estimate.
All right, Bloomberg's Hen Grazudis, thank you very much.
Coming up next on What You Missed, part of our exclusive interview with Raghuram Rajan, the former governor of the Reserve Bank of India, who is now with the Chicago Booth School of Business. His take on trade, Trump, and U.S. manufacturing. From New York, this is Bloomberg. What'd you miss? A few months ago, Raghuram Rajan finished a 3-year term as head of the Reserve Bank of India. Well, now he's back at the Chicago Booth School of Business. Rajan joined Tom Keene and David Gura this morning for an exclusive interview, and Tom Keene kicked things off by asking Rajan when he thinks the great bond market distortion could come to an end.
I think we're in the process of exiting. I think with the Federal Reserve seeing limited room for continued accommodation and starting to raise interest rates, I think you will see the pressure on other central banks also come off as much as it has been over the last few years to continue accommodation. So my guess is we're in the process of exit. How fast it will be will depend to some extent on conditions in the United States, what policies the new administration brings, how comfortable the Federal Reserve feels with those policies, and whether it feels it needs to move faster or slower, depending on what actually the administration proposes and how quickly it'll come in.
It seems to me that as one pressure comes off, another pressure comes on here. We heard the rhetoric about politics in the Federal Reserve here during the campaign. We're certainly seeing what's happening on Capitol Hill, a new round of senators and congressmen being sworn in today, many of them hell-bent here on changing the relationship between Congress and the Federal Reserve. How does this bank deal with that new politicization?
I think it's a very important issue, and it's there across the world. Because central banks have been the only game in town for the last few years, they've also acquired a sense of political power that certainly creates apprehension amongst the political establishment. And of course, they would like to control that power. Unfortunately, it is coming at a point when increasingly central bank independence will become important as perhaps inflationary pressures rise and central banks are asked to do the normal thing, which is control inflation, for which we've spent many, many years getting an apparatus which ensures the independence, ensures they can raise rates at the time that is needed without feeling somehow constrained by political pressures. So these pressures come at a time when it is really a very delicate situation for central banks.
Very delicate indeed. The backdrop to this, of course, is the possibility that we could see policy changes, tax reform, a big infrastructure spending package. For instance, it seems to me that the Fed is a real damned if you do, damned if you don't position when it comes to raising rates here, that they potentially could be blamed for doing the wrong thing whichever way they go. Absolutely.
And given the, as you said, the political situation, this is a time they have to tread very carefully. But I have no doubt that given the tradition they have established, the Fed will do what it thinks is right rather than cater to political opinion.
That was Raghuram Rajan. He's the Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He's also the former governor of the Reserve Bank of India.
Coming up, what you need to know for tomorrow's trading day. This is Bloomberg.
What'd you miss? A global equity rally kind of fizzled a little bit today as U.S. trading really went through the motions and everything.
Still some gains, though.
Still some gains. European stock 600, for instance, entering a bull market, up 20% from its low of February in last year. But when you look at the U.S. stock market, the Dow added more than 100 points. So there's that.
Yeah, getting closer to 20,000 once again.
All right, in terms of what's coming up tomorrow, I'm looking at European CPI. That's going to come out at 4 a.m. tomorrow. We're all waiting for some kind of 2% threshold to be reached.
We'll see if we get there. I'll be looking at Fed minutes tomorrow for the December meeting. Remember, they raised hikes in that December meeting, and they increased the dots for next year, so lots of interest. Those minutes out at 2 p.m. Eastern.
And don't miss this. President Obama will be visiting Capitol Hill tomorrow. He'll be meeting with Democrats on and basically strategizing on how best to protect the Affordable Care Act, his namesake legislation. Yes. That does it for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
Yeah,